Hello Apex entrepreneurs and welcome. This video is extremely important for those who want to make money from the stock market. If you're a beginner and want to invest your money in stocks, we recommend that you pay attention and watch this video till the end, so you can learn how to value a stock and which ones to buy. Now, many newbies make the mistake of buying a company stock just because they like that company. So for example, they might buy Samsung shares if they like their smartphone, or they might buy Louis Vuitton shares because they like their purses. But you might be surprised to hear that these types of investors end up losing money in most cases. Watching this video will help you to avoid these mistakes. The strategies we're going to look at in this video are inspired by a book called The Intelligent Investor, which we highly recommend that you read. If you're interested, follow the link given in the description and check it out. Now, before we dig deeper into our topic, we should start by discussing in depth the meaning of the word value. Well, really, everything has a value. Put simply, if you bought something at a price lower than its true value, it means you got a good deal. And if you bought something at a price higher than its true value, it means you got a bad deal. Let's take an example of a building in which there are 10 apartments of the same size. And let's consider that the average price of an apartment in this building is $400,000 US. So, the value of an apartment is near $400,000. So if for whatever reason one of the owners is desperate to sell you his apartment and he gives it to you for $300,000, then that's an excellent deal. Simple. This same simple logic applies for stocks. If you estimate the stock value to be at $30 and for some reason the stock is sold at $20, you should buy quickly. However, if the stock is being priced at $50, then you should short it. But how do we know what the true value of stock actually is? Well, there are a few different indicators that we can analyze that will help us to estimate the value of a stock. In this video, we're going to talk about 2 of them, and next week we're going to talk about 3 others. So stay tuned and don't forget to click the subscribe button and hit that bell so you get notified once the new video is published. So, on to our first indicator. We're going to look at the price to earnings ratio. And we can get the price to earnings ratio by using a simple formula, which is the current share price divided by the earnings per share. You can find the current stock price of a company on any financial website, and the earnings per share is the total earnings of a company divided by the total number of shares. So for example, if a company generated $4 million in profits and has 2 million shares, the earnings per share is equal to $4 million over 2 million shares, which is equal to $2. Easy to follow so far. Next, let's take the example of Facebook. And unless you've been living under a rock your entire life, it's a company that we all know. The earnings per one Facebook share for the last 4 quarters were equal to $2.38 for quarter 1, 85 cents for quarter 2, 91 cents for quarter 3, and $2.12 for quarter 4. So, to get the annual earnings per one share of Facebook, we simply add all of these numbers together, meaning the annual earning per share is $6.26. And it's this $6.26 that tells us how much profit per share Facebook made last year. For the next part of our equation, we're going to need the share price of Facebook, which on the 6th of January 2020 was $212.60. And to get the price to earnings ratio, all we have to do is a simple division. The share price of $212.60 divided by the profit per share, $6.26. which gives us $33.96. Now we know what you're thinking. We've given you lots of numbers to think about, but what do these all actually mean? Well, what this basically means is that you have to invest $33.96 in order to yield $1 in company earnings. And as a rule of thumb, the higher the profit to earnings ratio is, the more money you have to invest to yield $1 of company earnings. And the more overvalued this stock is considered. And vice versa. The lower the profits to earnings ratio is, the more this stock is considered undervalued. One common mistake people can make is often comparing the profits to earnings ratio of companies from different sectors, like comparing the PE ratio of a company in the tech sector to a company in the oil and gas sector. Well, this is just wrong and insane, so please don't do this. It's best to try and compare companies in the same sector. So for example, if the average PE ratio in a certain sector is 30 and one particular company has a PE ratio of 50, then it's likely that this company is overvalued. On the other hand, if the company's PE ratio is a lot lower than the industry average, then this company is probably undervalued. So like we said, always compare the PE ratios of companies in the same sector. Now, the profits to earnings ratio is a good indicator, but it has some limitations. For example, if a company has no earnings at all or is losing money, then the PE ratio doesn't exist, since we can't actually put anything into the denominator. Moreover, a major limitation of the profits to earnings ratio is that it doesn't take into account the growth in earnings. Therefore, two companies can have the same PE ratio, but the earnings of the first one are growing quickly and the earnings of the second one are steady over time. Of course, buying stocks in the first company that's growing quickly is a much more interesting and attractive offer. However, if we just used the PE ratio, this wouldn't be enough to lead us to this conclusion. Again, the problem being that the PE ratio doesn't take into account the growth of earnings. That's why analysing it alone is not enough. We need to analyse another indicator, which brings us nicely to the second indicator we'll be discussing in this video, the PEG ratio, and is equal to the price-earnings ratio of a stock over the growth rate of its earnings for a specified period of time. So we already know how to calculate the PE ratio, and for the growth rate, we usually consider the average growth per year over the last 5 years. Let's return to Facebook for an example and calculate the PEG ratio. So, as we learned earlier in the video, the PE ratio is equal to $33.96. or 33.96. And looking at Facebook's average annual growth per share over the last 5 years, it's around 48.3%. So the PEG ratio is equal to 33.96 divided by 48.3, which equals 0.71. When we look a bit closer at the formula of the PEG ratio, we can see that the earning growth is in the denominator. So, the more a company is growing, the bigger the denominator, and the lower the PEG ratio is. In simple terms, this means that the lower the PEG ratio is, the better it is. As a rule of thumb, when a company's PEG exceeds 1, it's considered overvalued, while a stock with a PEG of less than 1 is considered undervalued. We should note here that in the last couple of years, we've still been in a bull market, meaning the majority of stocks are actually overvalued. So it's really difficult to find a company like Facebook with a PEG ratio less than 1. In a bull market, it's difficult to find value. But in a bear market, you can find a lot of undervalued companies to buy. Okay, at this point, stop. Take a break, relax. We've given you a lot of information to think about in this video so far, which is why once you've finished watching, we'd like to invite you to take a look at the description, where you'll find loads of resources to help you make money working from home. You'll find the books that we recommend to help you acquire the right mindset for success, a free video course that will teach you how to generate passive income, how to create a 6-figure online business, and much more. Of course, all the methods we teach or recommend are not get-rich-quick methods. There is a lot of work to be done up front before you can enjoy the sight of money falling into your bank account. So don't hesitate to take a quick look at our description and, most importantly, enjoy learning. Now, to summarize everything from today's video. First, the price-earnings ratio, or PE ratio, relates to a company's share price to its earnings per share. A high PE ratio could mean that a company's stock is overvalued, or that investors are expecting high growth rates in the future. Companies that have no earnings or that are losing money do not have a PE ratio, since there is nothing to put in the denominator. The PEG ratio enhances the PE ratio by adding in expected earnings growth into the calculation. The PEG ratio is considered to be an indicator of a stock's true value. And similar to the PE ratio, a lower PEG may indicate that a stock is undervalued. So in our evaluation so far, we've taken into account the price of a share, the earnings per share, and the growth of the earnings per year. But this isn't enough. We still have to take into account many other parameters, such as equity, debt, and many others. And because learning how to value stocks is such a large subject, and because I've already talked for too long in this video, we've divided it into 2 parts. In the second part, we'll discuss many other important ratios. All you have to do to watch the next video is click on the link here or in the description of this video. And that's it for today. If you enjoyed it, don't forget to share it with one of your friends. Hit the like button and help us with the YouTube algorithm. Subscribe and hit that notification bell for more videos like this one. By the way, if you're still here listening to this lovely music, here are 2 videos that you'll love watching. Just click on either one of them on the screen right here.